All right, we're on Learning Objective 4.2. We are going to go through this objective and we're going to learn how to do the closing entries. This is your last step in the accounting process. In the previous video, I pulled up the steps. You should have those in front of you. This is the last step, okay? Um, and we have to do this because we have to prepare this period's books for the next period. So, if any of y'all have had parents who worked at any kind of like even a bookkeeping job or any other job, really, there might be like, oh, we got to work late because it's closing. That might be the end of the month. This is what they're talking about. Okay. And it's not so much the closing entries that's hard. It's a lot of work to get those adjusting entries fixed. Okay. So let's dive in here. Okay. We are going to divide out our accounts now and learn what are temporary accounts and what are permanent accounts. Okay. So your revenues, I know they have it right there too, but we have revenues, expenses, and the withdrawals. Okay. Remember the revenues is what we're making. That's what we're doing. Earning some revenue, service revenue. It could be sales. When we get to the next chapter, we're going to be selling inventory. So it'd be called sales then. And then we have all of our expenses. And then the withdrawal account. We're just looking at a sole proprietorship. So there's only going to be one withdrawal account. They threw this income summary in there. That account is only used during the closing process. You'll never see it on a financial statement. It starts with zero, it ends with zero. I wouldn't even put it in here as a temporary account, but they did anyway. Okay. Your permanent accounts, here's an easy way to remember them: assets, liabilities, and owner's equity. Aloe, like aloe vera. That is your permanent accounts. These never get closed. Okay. These always say, oh, it would be great if we could close out our liabilities, right? We can't do that because we would still owe it. Even if we made a journal entry to close out the liabilities, they would still expect us to pay that. Okay. But we close revenues, expenses, and withdrawals, and we're going to close those and we're getting them over to that capital account. Okay. There is four steps in this process. They go the same every single time. Remember, I told you chapter 3 was a little bit harder. We really had to think about those adjusting entries. You don't have to do a whole lot of thought when it comes to closing entries because you do the exact same thing every single time. Okay. So let's go through here. Okay. So here they have the process NT accounts. Not my favorite right there, but let's come down here and we're going to do the first step. All right. The first step is to close all revenue accounts. Okay. So close all revenue accounts. All right. We only have one revenue account, and I know you have the journal entry right there. Don't look at it. Okay. If we went back and looked at that adjusted trial balance, we had 17,500 in as a credit in service revenue. So I'm just going to mark that out so you don't look at it right now. All right. We're trying to close this out. This is a temporary account. We want it to be zero. So we're going to have to debit this account for 17,500. Okay. So we're going to debit the service revenue. That if that feels backwards to you, that's good because we are sort of going backwards. Okay. I'll give you a little acronym when we get to the last step on how to remember these steps, but we are going backwards here because I drew that zero there and I'm debiting service revenue. We're not supposed to debit service revenue. We credit it. It has a normal credit balance. Yes, it does. And that's why we're debiting it because we're making it zero. Okay. We are going to close it to that income summary account. Hang on with me just a second. I'm going to draw a T account out for income summary here in just a minute, but let's go through and let's do the expenses. Okay. They did the rent expense just because I like to draw it. I want you to watch me do this and be writing it down while you're watching this video. If I'm going too fast, slow it down, okay? So expenses have a normal debit balance, right? Rent expense had $3,000 debit in that account. We want to make it zero, so we are going to credit rent expense, and we're actually going to credit every single expense that we have. Okay, so here's the journal entry to close all of the expenses. So see, rent, salary, supplies, utilities, depreciation, they all were expenses, and they all had normal debit balances. So now we're crediting again. If this feels backwards, that's good because we are rewinding backwards. Okay. So I'm going to come over here and draw this T account for income summary. Okay. We credited income summary right up here for 17,500, which represents my revenues, right? Okay. We're going to debit income summary for 8950, which represents my expenses. So we're going to get a balance in this account. But here's the great thing. There's actually a check figure. We did the income statement for this problem. I know, I'm sorry, I'm scrolling up, but I want you to notice you have a check figure, okay? Net income was 8550. Look right here. Here's my revenues. Here's my expenses. And then I had a net income of 8550. So guess what's going to be left in that T account for income summary? Here we go. Okay. 8550 on this side. 8550. That is net income. What if we had net loss? We would have ended up with more expenses than we had revenues. I don't know why that did a little star there. So we would have net loss. So we're not going to have, but we can't have both. But if you do have a net loss, you'll end up with a balance on that side of the account. So this should make sense just a little bit to you. Revenues are on the credit side in income summary. That makes sense because revenues have a normal credit balance. Expenses have a normal debit balance. Okay, we just close them all out to income summary. Okay, our third step is to close the income summary account. Remember, I told you this account starts with zero, it will end with zero, it will never be on a financial statement ever. Okay, we are going to debit income summary, which is the net income, and we will credit the capital account. Look, they did that for us. Okay. So here's my debit. That 8550 is my net income. Okay. That is my net income. Check figure back up top. Okay. And we're going to credit the capital account. Okay. We're closing revenues, expenses, and withdrawals. We haven't got to the withdrawals yet. Closing them all to the capital account. Okay, so basically with the two journal entries we just did, we closed all the revenues and expenses into the capital account. Okay, we'll look at the capital account in just a minute. Okay, the owner had bright withdrawals, had $5,000 debit, right? Okay, $5,000 debit, and we got to make it zero because it is a temporary account as well. So we're going to credit the withdrawal account to make it go to zero, which they did right here. I'm going to come back to the capital. Okay. Journal entry for us to do that is to credit the withdrawal and debit the capital account for the $5,000 that was taken out. Okay. So let's look here. We have Bright Capital. It had a beginning balance. Sorry, I was trying to find, sorry about that. So we debited the capital account for 5,000. We credited the capital account for the 8550. That was net income. This is your withdrawals. That makes sense, right? Remember, we got net income is being credited the capital, so we're making capital go up. The owner took money out, so we are debiting the capital account to reflect them taking that money out of the business and out of their capital account. Okay. All right. Here, what is this? Oh, they told us if by some chance they had a $2,000 net loss, this entry right here is actually flipped. Okay. So I try not to go up and down too much. So right here, we debited income summary and credited Bright Capital. Notice how this is exactly opposite when it was the net loss, because remember that income summary, it would have a balance on the opposite side. Okay. So here is a summary of all of those. Literally, they're the exact same thing every single time. Okay. Step one, close revenues. Step two, close expenses. And then we're going to close that income summary. I like to write it out so you don't get confused with income summary with income statement. Close the income summary to the capital account, and then we're going to close the withdrawal account. Okay, here's your little acronym. We have REW. REW. All of y'all are probably so young you don't remember that that is an actual abbreviation for rewind, which makes perfect sense to rewind because in this closing process, I've already said if you feel like this is a little bit backwards, then that's good because that's exactly what we're doing. We're closing the revenues, expenses, and withdrawals to zero, and now those accounts have a zero balance in them so that we can start over for the very next period. Okay. So here they have the T accounts, and we'll stop this video and I will see you on the next one with Learning Objective 4.3.